Good morning, Robyn.
Hey, Paul, how are you?
I'm doing good, and welcome to everybody that is attending our webinar this morning, How to Recession-Proof Your Business. Our purpose in this webinar today is not to participate in the downward spiral conversation that can almost make a recession sort of a self-fulfilling prophecy, but really to help our business owners, our clients, and other followers of the firm be able to anticipate what might be coming towards us, whether it's a recession, a cool down, a slowdown, whatever term you want to use to describe what could happen in the economy, to empower you to feel like you can take some action, maybe some preventative action to help your business survive and thrive through an upcoming recession. So this session is being recorded, and we'll talk a little bit later where we'll store that if you want to refer to this program at another time. So let's get started. A little bit about us. For those of you that participated in our webinars all throughout the first 2 years of the pandemic, by now you know who Robyn and I are. If this is the first time you've participated in one of our webinars, Robyn is our tax practice leader for Mueller, Pye & Associates, and she oversees our Texas practice in Katy, Texas. Those of you that might not be familiar with Katy, Texas, that's a pretty large community, about 25 miles west of Houston. Yeah, something.
Yeah.
I still remember the geography down there.
Yeah, I would hope so.
Katy's a very vibrant community, both, from a business standpoint. So, it could be one of those areas that if there is a slowdown in the economy, probably a pretty good chance of weathering the storm, you think, Robyn?
Yeah, I do.
I mean, again, if it's 2008, we're all going to take a hit, but from what we've seen and the growth we've had in our Texas practice since Robyn joined the firm 5.5 years ago, it's a booming area.
It is booming here. It's so great to see.
That is. I'm Paul Mueller. I'm the managing director of the firm, and I oversee our Colorado practice from Loveland and Estes Park. So that's enough about us. So let's go ahead and get started with the program.
Yeah, so we really want today to be interactive. So open your chat, and if you guys have questions, ideas that maybe we haven't thought of, tips that you have to share with us that you've found useful in your own business, please share those with us. And we do want to kind of set some expectations. We don't have the magic formula. We don't have anything earth-shattering to share with you today. What we do hope is that we can share some fundamentals to kind of give you a framework to be successful in this kind of scary economy right now. We do have some unusual ideas that we don't recommend during normal times, but I think we can all agree these are not normal times. And then we're going to talk about some best practices, no matter what the price of gas is, no matter what inflation is doing.
Correct.
So that's kind of our goal for today. So please open your chat. I'll be watching the chat, and then the Q&A. Let's see, there is a separate Q&A button down at the bottom. So I'll be monitoring both of those things. So please feel free to share.
And I've got them open here on another screen as well. Okay. So I'll be watching for any kind of activity there. Okay. We may pause at certain times in the program to give you an opportunity to maybe type in a question into the program. But again, we want, in a Zoom environment, we've got your microphone and speaker turned off. So it's not something where we would expect you to speak up. A lot of people are Zoom shy, so I wouldn't anticipate anybody really would want to ask a question over the air, so to speak. But we want you to get the most out of this program too. So this is your webinar. We want you to be interactive with us in this Zoom environment. So yeah, we're watching the chat and the Q&A boxes, and we'll be addressing those items as we go along. Let's see. I heard this quote a few months ago from a Loveland business owner, and it really struck me as maybe a quote for the times. And he told me he heard this quote from a mentor early in his entrepreneurial career. So I don't have a name I can attribute it to, but the quote said, "The difference between most great athletes and an average athlete is their reaction time." And he told me he felt that that principle applies to running a business as well. So today we're going to share some tips and ideas to empower you that if you see something or you see some decline in perhaps performance in sales, maybe costs going up that you're having a problem controlling, that we help improve your reaction time, that when you see something, you're now ready to take some action and you know, again, help your business get through this particular area. So reaction time, remember that. See something, do something about it. So, you know, I guess the first question is, are we headed for a recession? And, you know, if you listen to some of the more high profile CEOs in this country, Elon Musk a while back said he had a super bad feeling. Might have been something he had for dinner. I don't know. Jamie Dimon, who runs JP Morgan, he said, brace yourself for a hurricane. We all know a week or so ago that we saw the largest single interest rate increase from the Fed in 40 years. They raised the benchmark rate by 0.75%, 0.75%. There's talk that there may be some other rate increases there. This is the Fed's way of trying to slow things down, trying to increase the cost of doing business or purchasing so that people maybe resist the urge to spend prolifically, which has been one of the causes of the inflation that we've had. And the Fed is trying now to tamp that demand side of the supply demand equation to try to slow that rate of inflation and try to achieve what they refer to as a soft landing for the economy without going overboard into a recession. I applaud their efforts for trying to do that. The challenge is that the Fed in these types of maneuvers has yet to achieve a soft landing when they take these aggressive interest rate measures. So maybe they've learned their lesson over the last 40 years and are maybe getting better at it, but we'll see how that goes. Recently, the S&P 500 crossed over into what they call bear territory. There's a significant enough decline that they fell into bear territory. You know, bears, bulls, all that. I'm not a market timer, market advisor, so those are just words to me. So, you know, if you read those kinds of signals, that's certainly, you know, people and events are certainly pointing towards some kind of a shrinkage of our economy, whatever word you want to use. On the other hand, there were 390,000 jobs added in May. That certainly is not a precursor for a recession. We've heard it, you know, there have been some announcements in the news with some companies having some layoffs, particularly companies involved in the crypto industry, massive layoffs in that area. But overall, the jobs, the growth in jobs seems to be holding strong. Some of the early signals for June, which that report is due out, could be tomorrow. I think that report is due out for the June jobs report. Early signals indicate that June is going to look pretty much as strong as May, maybe not quite as strong, but nonetheless, expansion in the job, filling those jobs that have gone unfulfilled. We also saw wage growth, which has been one of the big drivers of inflation. That wage growth in April shrank from a annualized 5.5% rate to a 5.2% rate. That certainly is an anti-inflationary measure. So Robyn and I don't know which way the wind is blowing, and you know, the old thing about hope for the best, prepare for the worst principle applies here. So Robyn, I don't know if you are taking this slide.
I guess I am now.
No, I am. Okay, this is my tee up for you. I'm sorry, I was not keeping up with my slides here. So, you know, Robyn talked about a framework, you know, that we're going to provide you some tips and ideas and do so in a framework that you can then work with. And the framework really comes down to what we refer to as the 3 Cs that are important in terms of running a business, particularly when you might be moving into challenging times. And those 3 Cs, the first one is cash is king. Cash is the most precious commodity in a certainly it was during the pandemic, and we certainly worked with our clients on things like PPP loans, employee retention tax credits, sick pay credits, all those things that helped infuse cash back into those businesses to help them get through some of those rough waters. Cash is definitely king. The second area is watching, but more importantly, controlling costs. We've been in a increasing cost environment now for almost a year. Your ability to control those costs and pass those on to your customers, vitally important. And then finally, creating capacity, looking for ways to either create more cash or more running room to allow your business to get through these challenging times. So the 3 C's: cash is king, controlling costs, creating capacity. We're going to jump into each of those. And the first one is, how do you manage that precious cash?
Now it's my turn. Now
There
I
you
get to
go.
talk.
There you go.
So this is what we refer to as the cash flow waterfall. So who gets paid first? And if you're the business owner on this call, you know that it's not the owners. The owners get paid last. But what order should you consider? If cash is tight, what do you do? So, and we're going to go into a little bit more detail on each one of these bullet points and talk about within that category, how can you conserve cash? So your employees get paid first, and then lenders, landlords, utilities, obviously you've got to pay the rent, you've got to have your internet, you got to have the power on. Within that group, and it may be on another slide, but don't forget that the IRS is a lender. We sometimes refer to that as a stealth lender because you may not see that number on your balance sheet as a payable. Hopefully if you're a client, hopefully you're in with us for mid-year tax planning and you're about to get an idea of how much money you're going to owe in the spring so that you can start conserving that cash. Vendors would be next. And then of course, if there's anything left, you want to put some in reserve for those months when things are not as robust or your sales are not as high as you had projected or hoped. Thanks, Mike. Yep.
Yeah.
Vendors are
Yeah.
number
Vendors
3.
are number 3. Yeah. Sorry, Mike. Vendors are number 3.
Sorry, you're down on the list.
But you're but you're number 1 with us, Mike.
You are number 1 with
Yeah.
us. That's our IT guy. For those of you that are wondering, we love him. He's
yeah.
So anyway,
Keeps
then
us
you want to
safe.
put some in reserve if you can. And then finally, the owners are going to get paid. So yeah, Mike, Paul and I are down farther on the list than you are.
Yeah,
If that
I was going
makes
to say,
you
we're
feel
number
any
5,
better.
Mike.
Yeah. So we're going to talk a little bit about each kind of category. So for your employees, obviously no one wants to lay people off. That's kind of an extreme, not ideal, of course. But it's always an option. Something else, if you've got a couple of employees that can share a job, everybody's going to, those two employees or 3 employees or how many ever can job share. And it reduces your payroll cost without you laying someone off. And hopefully when things get better, you can restore them back to their original positions with the number of hours that they're accustomed to. And then something that I think is really probably underutilized, and I'm going to admit I didn't know about this until very recently, but both Colorado and Texas have what's called a shared work program. So in Texas, that's administered by the Texas Workforce Commission, which is the same agency that handles unemployment. You file quarterly reports I guess it's quarterly reports to remit your unemployment tax to the state of Texas, and then they use that fund to pay out unemployment claims.
Which in Colorado is the Colorado Department of Labor and Employment that our employers here file quarterly to pay their unemployment taxes into that system.
So what's interesting to me about this is I don't think a lot of employers know about this, but let's say that you need to reduce hours by 15% across the board to help reduce your payroll costs. Well, those employees haven't had enough of a reduction to be able to file unemployment. What you can do is apply for this shared work program, and the state of Texas, through that unemployment fund, will kick in some to those employees and help supplement that loss in or that reduction of pay. So definitely something that you should look into if you've not in the past.
Yeah, and I think, Robyn, it's important to point out that part that Texas or Colorado kicks in isn't going to fully fill the gap between what the employee was making versus the reduced pay they're getting from their employer. But it is helping to fill some of that gap. So certainly something worth looking into. It's interesting. Last year, Robyn, we heard many of our clients talking about how difficult it was to hire employees, retain employees.
Yeah.
And now, we make this sudden shift where we're talking about we might have to, people might have to shrink their workforce a little bit. So it's like this. It's like we careen from one crisis to another.
Yeah.
We just got through a pandemic, and for the most part, a lot of people got through that pandemic, and they're looking to the future. And now we're talking about recession. So it's like we just go from one to the
like
next.
a roller coaster the last
it's
years.
and Robyn's referring to one of my comments is running a business is like riding a roller coaster. There's days where you're exhilarated, it's fun, it's exciting, you're shouting your fool head off. There's other times you just want to get back to the station so you can get off and go throw up. So that's the entrepreneurial experience. I equate it to the man in the arena speech by Teddy Roosevelt. You're down there in the game, and you're taking the blows and getting through it. So it's a great experience. I wouldn't trade it for anything.
Yeah. So last comment on this, and it's in big bold down at the bottom, but we're certainly not experts on employment law. So please make sure that you're consulting with HR and your legal advisors before you take any of the steps listed above. So I think Paul's going to talk about how to manage lenders.
Yeah, so lenders, if you remember on the waterfall, lenders were next. They were lumped in there with landlords and utility providers, but let's specifically talk about lenders. This would be a time to, if you don't have a line of credit, that maybe you need to contact your banker about getting a line of credit. For those of you that may not know what a line of credit is, it's a standby loan. It's an amount that the bank says they will loan to you on an as-needed basis. So if you haven't borrowed any money on the line of credit, you're not paying any interest expense on it. And when you do borrow on that line of credit, you're only paying interest expense on the part that you did borrow. So let's say you went and got a $50,000 line of credit. Well, that's a standby ready source of cash that the bank is ready to loan to you as soon as you let them know you need some or all of it to be sent to your bank account. If you do have a line of credit, maybe now's the time to think about increasing that line of credit. So if you had a $50,000 line of credit, might be worth having a conversation with your banker right now about doubling it, or to $100,000. The idea is this line of credit is a way to help you maybe get through a temporary cash shortfall to get you, to hit payroll or to be able to pay your rent, some of those other expenses, and then earn future profits in your business to pay that loan back as quickly as possible. So again, Robyn, the old joke about, when's the best time to ask for a loan?
Before you need it.
Before you need it, yeah. So if you max out your line of credit and you're hoping to increase it at that time, and your numbers may not look as good as they do right now, that may not be the best time to ask the bank to increase that line of credit. So
if the bank sees that you need it, they're not going to give it to you.
That's right.
I mean, that's I don't know if you guys know this, but my husband works here now. He's our CFO, and he came from a banking career of 25 years. And so I've heard this for the last 25 years. He can also be a resource for you guys. If you have questions, we get a lot of questions about, I need a loan and what's the best way to go about this. Please reach out. He can help.
Sure, Garrett's ready to share his knowledge in this area. But this is something. And when you're managing your lenders, look at the current lending relationship, and do you need more? The other thing is, if you need to, don't hesitate to ask for some kind of payment relief with your bank. I realize there's people out there that probably think you're not allowed to do that, or the bank is going to take some kind of negative action. If we do get into some kind of an economic downturn, you're not going to be the first person who's ever asked the bank for help. Some kind of structured payments, deferred payments, interest-only payments, whatever it is, do not hesitate to ask the bank to see if they're willing to work with you and help you get through sometimes. because the bank wants you to repay that loan at the end of,
Yeah.
at the end of some period. And if they don't help you through the tough times, it does put that entire loan at risk. So the bankers are smart about that, and they're willing to help. If
Paul,
you
I think most, I'm sorry, I didn't mean to interrupt, but I think
no, go
most
ahead.
banks have what they call a workout group. So if
Mhm.
you're having trouble meeting those obligations, they have a special department, and that's all they do is help you work through those tough times to get you back on track. So,
And you never get what you don't ask. So
yeah.
again, don't hesitate to ask for some kind of help from your lender. The SBA, a lot of people, discount the value of SBA loans, and to some extent, SBAs are like the lender of last resort. Typically, before you can get an SBA loan, you have to show that you've exhausted all your other traditional lending options. So let's say you've asked your bank for a loan and they've turned you down. That gets you one step closer to working with the SBA, actually. So that's bad news. The good news is it gets you one step closer to working with the SBA. And they have a number of loan programs here. And I'm not going to read through all of these, but they do have loan programs specific to owner-occupied real estate and other types of lending situations there. So don't just immediately throw away the SBA. That could be an area of relief in your lending relationships.
Is this me or you, Paul?
Yeah,
We're
this
real
is me.
organized today.
Yeah,
Okay.
I'll take this one. And by the way, before I jump in, I'm there's been no questions posed in the Q&A, so we are watching over there. So again, if you see something or hear something as we're going through it and you want a little more clarity, be sure to pop those questions into the Q&A section. So the next thing is number 3. This is Mike who sent us a chat. Number 3 were the vendors on that cash flow waterfall. And with your vendors, communication is key. Chances are they're feeling some of the same pressures that you're feeling as a business owner. And being able to communicate with your vendors early on, particularly if you need to ask for some kind of flexible terms or payment relief from them. Honest communication with your vendors can really, and timely communication can go a long way in help in getting them to help you through this time. Again, just like with the lenders, your vendors want to continue to do business with you. They'd rather do business with you on some kind of a structured, flexible basis as opposed to see you go away as a customer. So ask for help in this area and see how they respond in this situation. For those of you that maintain inventories, whether retail or manufacturing, where you've got a lot of raw materials in your warehouse, take a critical look at those inventory levels. In our accounting speak, there's a ratio, the financial ratio called inventory turnover, and it sounds real complicated, but what it's really meant to do is track how long it takes you to sell out or roll over your inventory during the year. So, the most common example is you maintain an average inventory level throughout the year of $500,000, and your cost of goods sold for the year is $2 million. Well, we put our accountant's hat on and we say, well, you're turning that inventory over 4 times a year, which means basically every 3 months you're selling out that inventory and replacing it. If you can talk to your suppliers and you can find out that based on their, from the time you order until the time you receive those materials, if that time is as little as 1 month, then maybe you're carrying 3 times too much inventory on hand. Maybe you can shrink all that, how much inventory you have on hand, which frees up cash immediately to go put to other uses. So take a critical look at how much inventory you're keeping on hand, how quickly can it be replaced, and are you carrying way too much inventory and tying up too much cash for those materials that are sitting in the warehouse. In the other area of inventory, sometimes mistakes get made. When you place an order and it arrives on the dock at your warehouse, sometimes there's mistakes in there. Maybe the supplier sent you too much, more than what you asked for, or maybe they sent you the wrong things that you didn't ask for. your warehouse people should be critically looking at those deliveries that they're receiving with the original purchase order to make sure you're getting exactly what you needed. And if you didn't, or if you received too much, send it back for a credit. You don't need to tie up further cash on mistakes that are made in shipping goods to you. So your warehouse people need to take a critical view on what's coming in versus what you ordered, and make sure there's a match on that. And then the last point on this is think about the small guy, the small supplier to you that's perhaps depending on you paying their next invoice for them to stay in business, and they're really living on a thin margin. When you're looking at your vendors, they're probably all equal, but maybe some are more equal than others. And maybe it's the small guy that needs the help the most when there's only so much cash to go around. So think about the small guy and see, help them stay afloat during this time.
Yeah, so if you're an owner, on the call, or you're in charge of the one managing receivables, so this is something that you get so busy running your business that you don't stay on top of your AR. And we've found just in our business that the longer it sits out there, then the person's it's just another email and they're just ignoring it. So at least weekly, you need to be on top of your AR. The other thing that we found is don't just send an email reminder, just pick up the phone and call that person. And a lot of times what we found is somebody's staring down this invoice and it's unmanageable for them at the time. So offer to break that into some sort of payment. Maybe they can pay $100 a month, but they can't pay you $1,200 all at once. They want to pay you. Just get on the phone, have a human conversation about it, and work something out. If you don't accept credit cards, and I know the merchant service fees are 3-4%, but it's better than them stringing you out for another couple of months. So if you don't take credit or debit cards, I highly recommend it. It's people are far more likely to pay you on a credit card if cash is tight. It's one of their lenders, it may be that line of credit for a small business, and that may be how they get you paid. And then the other thing, build retainers into your proposals so that you're going to get something up front before you start that project or invest any work or any money into that project. And then if your vendors are offering you, a 2% discount to pay within 10 days or whatever the case, consider foregoing those discounts in order to buy yourself a little bit more time to make those payments.
So Robyn, let me jump in there real quick on the accounts payable, because we do have clients. I've talked with clients that they're like, as soon as they get that bill from a supplier, just pay it. Sometimes you have 30 days to pay without any kind of a late charge or penalty. It's okay when we're in prosperous times and there's plenty of cash to go around. I just want to go back to what we said that Robyn said early in the program, that we're going to provide some unusual ideas for abnormal times. So in normal times, if you want to pay your suppliers in 2 days, and because you just don't want that bill in your system or that payable hanging over your head, that's great. Let's take into account, we're talking about an environment where cash is getting a little bit tight, and you're needing to manage that cash is king principle. So this is where you might trade out that discount that the supplier is offering you for time, for more time to pay that invoice. So again, some of these things we wouldn't do normally, but when we're in abnormal times, calls for action.
Right. And take a look at your critical suppliers and vendors. Who are the most, your largest or your most important, or whatever the case. And, they're willing to work with you on some sort of payment plan, just like you're willing to work with your customers on the AR. You are that person to them, some sort of payment plan. And if you continue to pay something, more likely than not, they're going to continue to want to work with you. And then if you do have loans outstanding, make sure that you are staying in compliance with the terms of the loan and any covenants. And, the last thing you want is for your loan to be called during this, cash crunch, and all of a sudden, oh, you didn't meet your covenants, or, whatever. And then all of a sudden, well, now you're going to the workout group at that bank and trying to get something. So make sure that you know what those terms are, you know what those covenants are, and that you're complying with all of those.
And Robyn, along those lines, many times those loan covenants come with penalties, so that if you if you bust a loan covenant, the bank has all the right in the world to assess you a penalty for violating that covenant. And so going back to what I talked about earlier about managing vendors and asking for relief, make sure you understand your loan terms and your loan covenants. And if you see a train wreck about to happen, that's the time to speak up with the banker. There's always a chance that before you break that covenant, the bank might be able to waive that penalty. But once you break that covenant and the bank finds out about it, they're a lot less reluctant to talk about waiving those kinds of penalties. So again, early communication is key.
Yeah. And if you don't understand what those covenants are and what some of that language is in that agreement, reach out to your lender and ask, or give Garrett a call. I mean, he left banking for a reason, and here I am offering up all of his lending expertise. I hope he's not on this call.
Give him more work to do.
I know. And then keep close to your good customers. Make sure that in these unusual and difficult times that you're not letting that relationship fall off of the table. That's important, especially in this COVID, in this post-COVID world we're living in. So
it's all about helping each other through this.
It really is. They're a small business just like you.
That's right.
Or a family trying to, make it or whatever.
So that's the first C. We covered cash is king. The second one that we'll cover briefly here is the idea of controlling costs. And it really, it falls into the profit and loss statement is the area where you can monitor those costs and be able to spot early signs that there's some costs that need to be reined in. I just took, the traditional profit and loss statement here. Some of you may have a full, page long or 2-page long P&L with dozens and dozens of line items on it. I just distilled it down to its 5 key elements. There's sales, that's obviously your revenue, the cost of sales, which are those direct labor and material costs that produced that revenue. When you subtract that out, you get down to what's called your gross profit. After gross profit, you then subtract all of your general and administrative costs, typically overhead type costs, and that gets you to your net profit. Those, in a nutshell, those are really the 5 key numbers that every business owner should know, every day, every week, every month. If you're using QuickBooks Online, it's easy enough to produce a P&L, and you can actually compress that P&L so you can just look at these 5 numbers without getting into all the weeds and the details. In terms of sales and cost of sales, one of the principles to look at when if you're looking at your P&L is the increase or decrease in cost of sales should be moving in tandem with your sales. So if your sales are up 10%, theoretically, the cost of sales, the labor and the materials that produce those sales should be up somewhere around 10%. They should be moving somewhat in tandem, not perfect, but certainly moving in the same direction. On the other hand, if you look at your P&L and you see that your sales for the first 6 months of this year are running relatively flat to the first 6 months of 2021, but your cost of sales are up 15%, that's a bad sign. That's eating into that gross profit margin. And oftentimes gross profit is where the battle is won or lost. You've got to make it with the gross profit area to make sure you can cover your overhead. So be watching where cost of sales, where the increase or decrease in cost of sales is running counter to your increase or decrease in sales. That would be one of those early signs that requires you to react and improve your reaction time to be doing something about that. Maybe you need to be adjusting the prices you're charging your customers to pass those increasing costs along. Whatever it might be, we're ready to have those kinds of conversations with our clients about options that they can do when they see that cost of sales is not running in tandem with sales. In the overhead area, this is an opportunity to engage your team and make it everybody's responsibility to look for ways of cutting costs. And that's why I put down there, why should employees care about restraining spending and cutting costs? Because the job they save might be their very own. So make it a team effort. If you do a company picnic every summer, maybe instead of a fully catered event, maybe a potluck picnic might be called for, where everybody participates and brings something and shares something. If you have salespeople that are traveling a lot, maybe a Hampton Inn instead of the Hyatt Regency is called for in these times. Just those things where if you communicate with your team, chances are they can bubble up ideas on ways to save money, because they know they want to keep their jobs and they have skin in the game too. So something to think about as you look at your P&L and you look at some of these costs, and what to do to try to rein those in.
Be careful who you're letting book accommodations. That's all I'm going to say. I mean, here in our firm, Paul is not allowed to book anybody's accommodations.
There you go.
He booked us at some pretty sketchy places.
Guilty as charged.
Yeah. So the last C that we're going to talk about is creating capacity. So I don't know if you're not familiar with the term cash out refi. What that means is refinancing a property that you own and taking some of the appreciation. So taking some additional equity out of that in the form of cash. So let's say you bought a building for $200,000 and now it's worth $400,000. You can go back to the bank and refinance that property, increase your loan, and take some of that equity out in the form of cash. And you can do that tax-free. Yeah. And you can do that with your personal residence as well. And then there's also a HELOC, stands for home equity line of credit. So one of two ways on the personal residence, you can do the cash out refinance, or you can obtain a line of credit on the equity in that home. And those are great ways to increase the cash coming to your building. Again, all of that is tax-free. Of course, you've got to compare the interest rate you had versus the interest rate you're going to get. But still sometimes can be less expensive than obtaining a conventional loan at the bank, I would say.
And probably faster too.
And yeah, true. Probably a lot less, probably much, much faster.
Yeah.
And then, like we talked about earlier, some of what we're talking about is unconventional. We don't always recommend that you borrow from your 401k, but it can be a great option. You're borrowing from yourself. And so if you're paying interest, you're paying it back to yourself. So, as long as you're confident that you can repay that, it can be a great option for some pretty quick cash. I think your plan has to allow for it, but I think most 401k plans do allow for that. Within, there's limitations. You can take, you can't take it all, but you can take a portion of it or some, dollar amount. And again, pay the interest to yourself.
Well, and that's better than taking a taxable distribution from the 401k, where you're, right off the bat, you're going to have probably 20 to 30% paid out in state and federal income taxes. So this loan mechanism is a way to create some short-term cash availability with a long-term repayment plan on that. So again, this is about, as a business owner sitting there looking at bills, at payrolls that need to be met, when you start thinking about how do I create more cash capacity, these are just some ideas that could help solve that equation.
Yeah. And then there's ways to create capacity at home. So I think Paul's going to share some of those things.
And sure. So, some of these tips work at home too. If you're doing the right thing and you're participating in a 401k and you're having the maximum taken out of your pay because you really want to fund your retirement, you can turn that off. Again, this isn't something we normally recommend to our clients. We love our clients to save for retirement and take advantage of all those tax breaks. But again, if cash is tight, if you're looking to free up some capacity in terms of cash, you can turn off those retirement plan contributions. Always turn them back on later when things turn around and things are good. But that is one way to create extra cash in that net paycheck each payroll period. How many of us have memberships to gyms, multiple streaming services on our TVs and our phones and all of that? Maybe it's time to take a critical look at some of those subscriptions and consider suspending them or eliminating those recurring charges. With those recurring charges, we often forget they're even there and that they're hitting our credit card statement every month. So if you haven't been to the gym in 6 months and you're still paying a monthly membership, maybe it's time to cut that off and keep those dollars in your pocket and create some capacity that way. In terms of credit cards, again, these credit card companies have workout groups. So if you need some kind of help, if you can't even make minimum payments on that, it's time to ask for help from the credit card company. If your credit cards are all paid up and you pay the bill every month, using credit cards to make current payments is a great way to postpone actually having to pay the bill. So, if it's your phone bill, utility bill, rent, anything that can be put on a credit card, maybe that buys you an extra 20 to 30 days before you have to make good on that payment. Again, this is all about creating capacity. If you have to, maybe consider making minimum payments for a while. I know that interest rate is choking you if you make those minimum payments. It's like you'll never pay that credit card down. Again, this is all about buying time and holding onto your cash. Something else is, it kind of goes along the lines of those recurring charges. Maybe actually download your credit card statement for the last couple of months and go through there and see what are you spending your money on. You might see some things in there that, man, that's easy to cut out. We need to stop that. Let's don't ever do that again. You might get some ideas on ways to cut spending. Buying food wisely. As all the folks in Colorado, as this is farmers market season. We, typically in most communities on a standard day of the week. Here in Estes Park, where I am today, we have a farmers market every Thursday morning here in town. Take advantage of those farmers markets where prices might be a little bit better for some of those vegetables and other farm-raised staples. It's a nice way to support some of your local ag folks as well. We don't see coupons much anymore with grocery stores, but certainly there's sales and deals. Shop critically and stock up on things when they're at a good price on sales. But don't overbuy on those items and wind up with a bunch of stuff you have to throw out. That's, that kind of waste works against creating that cash capacity at home. And like we've said before, take a look at your opportunity to refinance your house or obtain a home equity line of credit or HELOC on your home. That might just be enough of a cushion there to get you through some choppy waters. So we wanted to end the program today and talk about some best practices that apply in any economy. So what we've talked about so far is really those action items to take during a critical time or a downturn that you might have. We just wanted to share, there's some things we should be doing all the time, regardless of what the economy is. And, first of all, be scrupulous about extending credit to your customers. The customers that pay on time, you can work with them on extending credit to them, but watch for folks that might take advantage of the situation. Just be cautious about, again, all your customers are equal, but some of them may be more equal than others. So, be careful about who you give credit to and who you don't. Robyn said earlier about consider accepting credit cards for payment. When we did that 8 years ago at our firm and began to accept credit cards, and that was back in the day when CPA firms really didn't take credit cards. It was kind of like, is this unseemly? But we got over that pretty quick, because what we found out is when we gave our clients an opportunity to pay their invoices by credit cards, they paid a lot faster. It was more convenient. And I would rather they work with their credit card company for repayment instead of working with me on repayment. Like we said earlier, with that P&L, monitor those creeping costs and impact on profit margins. You may have a supplier that says we're pushing through a 5 or a 10% increase, and you'll know about those and you'll be able to react to those. But it's the creeping costs. It's the 0.5% or the 1% a month that just seems to creep over time that we sort of lose sight of. So again, be watching your sales, your cost of sales and gross profit on a macro basis to see if you see those creeping costs having an impact on those profit margins. Make cost savings a team effort. Everybody's got skin in the game. And then the other thing is, they always say it's lonesome at the top. And as a business owner, you're the person at the top, and it can be a lonely situation. So if you don't already have a team, cultivate a team of peers and advisors that you can rely on, that you can use as a sounding board. So when you're thinking of actions or ideas or strategic direction, you've got a group to go bounce it off of, so that you're just not relying on your own knowledge alone. Robyn,
Hey, Paul,
anything?
we've got a great question over here.
Oh,
Ways to control merchant fees.
shop it. So many of our clients are on QuickBooks Online. Intuit has a merchant processing system. You can see what their fee structure is like. Remember, with merchant fees, a lot of times there's a different percentage fee on whether you're swiping the credit card or running it manually, or you're calling it in on the phone. There can be some different rate structures. So make sure you're doing a full apples to apples comparison if you're looking at multiple merchant processors. A lot of merchant processing companies also have a monthly fee that sometimes, depending on the amount of sales volume you're running through on that credit card, they may waive that monthly fee, others may not. So again, it's an apples to apples comparison. I would say, again, if you're on QuickBooks Online, see what Intuit's offering, contact your bank where you're doing your deposit activity or your loan activity, see what their merchant processing system looks like. I think even Sam's Club might have a merchant processing system. So you can probably go online with Sam's Club and see what they're offering in terms of what their merchant processing fees are. Shop it. Definitely shop it.
Mm-hmm. Paul, what do you think about passing that charge on to your customers? I mean, you've seen that, right? If you pay by credit card, there's a 3% convenience fee or 1.5% convenience fee, like they're splitting it with you or something.
Yeah, I can tell you, when we implemented credit cards it might have been 9 years ago now that I think about it.
Mm-hmm.
To us, that was a cost of doing business. And,
Yeah.
we figured getting paid faster was worth that processing fee. Build it into your pricing. It's another cost of doing business. And when you begin to accept credit cards, you'll be amazed at how many customers are willing to use that as a medium of paying your invoice. So work it in as a cost of doing business.
Yeah. So over in the chat, this is such a great question. We have this conversation with our clients all the time. So instead of chatting it over here, I'm going to go ahead and discuss it live. But the question, so regarding the cash flow waterfall, there's got to be a balance between how much a business is putting in reserves and how much they're distributing to the owners. So a couple of thoughts on that. So we usually tell clients 3 months operating expenses, or that's what I usually tell clients, Paul. It kind of depends on their business, but somewhere between 3 and 6 months of operating expenses is a good rule of thumb for cash reserves. And you don't want to build up too much cash in your business because the point of your entity is to limit the liability to whatever assets the entity owns. Again, I'm not an attorney, but that's the general idea of it. And cash is a really pretty asset. So if there's an accident, you get sued, something like that, the cash is going to be the first thing that potential,
it's the first thing the plaintiff's attorney is going to look for is a balance sheet as of the date of the accident, because they want to see how much cash you had, because that helps them frame their settlement proposal.
They don't want your machinery and equipment. They don't want your computers. They want your cash. So we usually say 3 months operating expenses, and really probably everything else should come out as distributions. Something else that you can distribute out the cash with either a formal agreement or some kind of handshake deal with your partners that if we need this money back, you've got to reserve a certain amount of that to be able to loan back to the company should we need it.
Mm-hmm. Yeah. So there is a tension there about Oh, different owners may have differing perspectives,
I
and
know.
certainly we see that with some of our clients that have both
Sure.
active, owners who are active in the business and owners who are the proverbial silent investors. Um, we sometimes find that those so-called silent investors aren't so silent uh,
Right.
when there's an expectation that they want to be paid back on part of their investment. So yeah, there's
Yeah.
always that tension there.
Yeah. So let me know if you've got more questions on that topic. And then Mike just shared an article, which I can't pull up the article. I'm
Yeah.
not logged in. Colorado retailers can now charge customers more for paying with credit cards. Can assess a surcharge of as much as 2% on anyone who pays with a credit card.
That's in Colorado.
Interesting.
Yeah.
Yeah. Okay.
I just wonder how that might aggravate a customer.
I don't know.
To actually see it. I just think you bury it in
I don't
the
know.
price and don't create more tension
Yeah.
between a
Honestly, it doesn't bother me
business.
when I see it. I just pay it and move on. But
Move on. That's right.
yeah.
Yeah.
So I don't know.
Okay. Let's see. I think that's it. We had one question. Thank you for some of those comments in the chat section. We appreciate that information. If you have questions after this particular program, if you have specific items that you really want to drill down on, give us a call. I have our phone numbers here on the screen for both our offices in Colorado and Texas. We have a general email box, info@mpa.cpa. You can submit questions or inquiries there as well. We're monitoring that inbox, and we'll get back to you as soon as possible. Also, I just want to remind everybody we are recording this webinar, and we will be uploading that later to our YouTube channel, which is Have an IPA with a CPA. If you go on Google and you type in Have an IPA with a CPA YouTube, you'll go to our channel, which is where we've uploaded all of our webinars. We have videos from the last several years on all kinds of topics. There's just a lot of rich content there in video format for you to take advantage of. And later this summer, we'll be uploading more videos to our YouTube channel. So if you go to that channel, make sure you subscribe so that you do get notifications when we do add new content to that page. We try to keep it fresh and up to date as possible. So with that, we don't know which way the economy is headed. We're not sure how things are going to wind up, but we hope you feel better equipped to encounter whatever situation might come at you as a business owner. And remember that we're always here to help you through those times. So great. Enjoy your day, and we look forward to hearing from you.